Question 1. In Texas, what is the primary purpose of the free look provision in a life insurance policy? A. It allows the policy owner to cancel the policy and receive a full refund of premiums paid within a specified period after delivery. B. It permits the policy owner to make changes to beneficiary designations without the insurer's approval. C. It enables the policy owner to borrow against the policy's cash value during the initial policy year. D. It provides a grace period for premium payments if the policy owner forgets the due date. Answer: A. It allows the policy owner to cancel the policy and receive a full refund of premiums paid within a specified period after delivery. The free look provision, also known as the right to examine period in Texas, gives the policy owner a specified number of days, usually 10 to 30, after receiving the policy to review it and decide if they want to keep it. If they are not satisfied for any reason, they can return the policy to the insurer and receive a full refund of all premiums paid. This ensures consumers have time to understand what they've purchased without financial penalty. Always remember that the free look period begins when the policy is delivered, not when it's issued. Question 2. A life insurance policy includes a waiver of premium rider. If the insured becomes totally and permanently disabled, what is the primary benefit of this rider? A. The policy's cash value will immediately be paid out to the insured. B. The policy's death benefit will increase by a specified amount. C. The insurer will waive future premium payments as long as the disability continues. D. The policy will convert to a paid-up policy without further premiums. Answer: C. The insurer will waive future premium payments as long as the disability continues. The waiver of premium rider is a valuable additional benefit that can be added to a life insurance policy. Its primary purpose is to protect the policy if the insured becomes totally and permanently disabled before a certain age. If this occurs, the insurer will pay the premiums on behalf of the insured, ensuring the policy remains in force and its benefits, such as the death benefit and cash value accumulation, continue without interruption. This rider provides financial security during a time when income might be severely impacted. It's a key rider to remember for protecting policy continuity. Question 3. What is the primary responsibility of the Commissioner of Insurance in Texas? A. To set insurance premium rates for all lines of insurance in the state. B. To market and sell insurance policies to Texas residents. C. To regulate the business of insurance, protect policyholders, and ensure compliance with insurance laws. D. To resolve all disputes between insurers and policyholders without judicial review. Answer: C. To regulate the business of insurance, protect policyholders, and ensure compliance with insurance laws. The Texas Commissioner of Insurance, who leads the Texas Department of Insurance, TDI, is primarily responsible for regulating the insurance industry within the state. This role includes ensuring that insurance companies are financially sound, that insurance products are fair, and that agents and adjusters operate ethically and legally, all with the ultimate goal of protecting the public interest and policyholders. Think of the Commissioner as the chief watchdog and enforcer of insurance laws in Texas. Question 4. After a fire loss, the insurance company pays the insured for damages to their property. The insurance company then seeks reimbursement from a third party responsible for the fire. This process is an example of A. Salvage, B. Coinsurance, C. Subrogation, D. Arbitration. Answer: C. Subrogation. Subrogation is a legal right that allows an insurer to step into the shoes of the insured after paying a loss and pursue recovery from a third party who caused the loss. For example, if a neighbor's negligence causes a fire that damages your home, your insurer pays you, then subrogates your right to sue the neighbor, recovering the money they paid out. This prevents the insured from being compensated twice and ensures that the party responsible for the loss ultimately bears the financial burden. Question 5. Which type of life insurance policy is characterized by a flexible premium and flexible death benefit, along with the ability to build cash value? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is known for its flexibility, allowing policy owners to adjust both their premium payments and their death benefit amount after the policy is issued. It also accumulates cash value, which grows on a tax-deferred basis and can be accessed through withdrawals or loans. Think of universal life as a policy that offers both permanent coverage and adaptability to changing financial needs. Question 6. All of the following are typically covered perils under a Texas DP-1, Dwelling Policy Form 1, Basic Form, except A. Fire. B. Lightning. C. Internal explosion. D. Vandalism and malicious mischief. Answer: D. Vandalism and malicious mischief. The DP-1 basic form is the most limited of the dwelling policy forms, typically covering only the named perils of fire, lightning, and internal explosion. Perils like vandalism and malicious mischief, VNM, wind, hail, or extended coverage perils are generally not included in the basic DP-1 and would require an endorsement or a broader policy form, like DP-2 or DP-3, to be covered. Remember that basic means very few perils are covered. Question 7. The incontestable clause in a life insurance policy typically prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for a specific period, usually A. 30 days. B. 6 months. C. 1 year. D. 2 years. Answer: D. 2 years. The incontestable clause is a crucial provision in life insurance policies that protects the policy owner. It states that after the policy has been in force for a specific period, most commonly 2 years from the issue date, the insurer cannot deny a death claim based on any material misrepresentations or concealments made by the insured on the application, with the exception of fraud in some states or non-payment of premiums. This clause provides assurance that, after a certain time, the policy's validity cannot be challenged for past inaccuracies. Question 8. An insured has a commercial building valued at $400,000. Their policy has an 80% coinsurance clause and a policy limit of $280,000. If they suffer a $100,000 loss, how much will the insurer pay, ignoring any deductible? A. $100,000. B. $87,500. C. $70,000. D. $280,000. Answer: B. $87,500. Coinsurance encourages insureds to insure property to a certain percentage of its value. To calculate the payout, first determine the required coverage, $400,000, value, *80%, coinsurance, equals $320,000. Next, find the proportion of coverage carried versus required, $280,000, carried, /$320,000, required, equals 0.875, or 87.5%. Finally, apply this percentage to the loss, $100,000, loss, *0.875 equals $87,500. This is the amount the insurer will pay because the insured did not carry enough coverage relative to the coinsurance requirement. Question 9. Which annuity payout option guarantees income payments for the lifetime of the annuitant, but stops payments upon their death, with no further payments to beneficiaries? A. Life with period certain. B. Refund life annuity. C. Joint and survivor annuity. D. Straight life annuity. Answer: D. Straight life annuity. A straight life annuity, also known as a pure life annuity, provides the highest possible periodic income payment to the annuitant because it guarantees payments for their lifetime, but all payments cease upon their death, regardless of how soon that occurs. There is no provision for beneficiaries to receive any remaining value or payments. This option carries the highest risk for the annuitant if they die early, but also the highest reward for longevity. Question 10. The Texas Windstorm Insurance Association, TWIA, provides wind and hail insurance coverage for properties located in designated catastrophe areas along the Texas Gulf Coast. What type of insurer is TWIA? A. A private, for-profit insurance company. B. A government-funded social insurance program. C. An insurer of last resort. D. A reciprocal exchange. Answer: C. An insurer of last resort. The Texas Windstorm Insurance Association, TWIA, is an insurer of last resort for wind and hail coverage in designated coastal areas of Texas. It was created because private insurers often limit or exclude these coverages in high-risk zones, making it difficult for residents to obtain essential protection. TWIA steps in to ensure that properties in these areas have access to basic wind and hail insurance when it's not available from the voluntary market. Question 11. An agent convinces a client to replace an existing life insurance policy with a new one that offers no real benefit to the client, primarily to earn a new commission. This unethical practice is known as A. Churning. B. Rebating. C. Twisting. D. Coercion. Answer: C. Twisting. Twisting is an illegal practice where an agent or insurer persuades a policy owner to lapse or surrender an existing life insurance policy in order to purchase a new one, when doing so is to the policy owner's detriment and not in their best interest. This often involves misrepresentation or misleading comparisons to make the new policy seem more attractive. The key element of twisting is the act of replacing an existing policy to gain a commission. Question 12. Which of the following best describes property damage, PD, liability coverage in an insurance policy? A. Coverage for damage to the insured's own property. B. Coverage for physical injury, sickness, or disease to third parties. C. Coverage for damage to property of others caused by the insured's negligence. D. Coverage for loss of income due to property damage. Answer: C. Coverage for damage to property of others caused by the insured's negligence. Property damage, PD, liability coverage is designed to protect the insured when they are found legally responsible for causing damage to someone else's property. For example, if you accidentally back your car into your neighbor's fence, your property damage liability coverage would pay for the repairs to their fence. This coverage does not apply to damage to your own property, which would typically be covered by property coverage sections of your policy. Question 13. How long is the grace period for an individual ordinary life insurance policy in Texas? A. 7 days. B. 15 days. C. 31 days. D. 60 days. Answer: C. 31 days. In Texas, the grace period for an individual ordinary life insurance policy is typically 31 days. This is a mandatory policy provision that provides a period after the premium due date during which the policy remains in force, even if the premium has not been paid. If the insured dies during the grace period, the death benefit will be paid, less any unpaid premiums. This provision prevents the policy from lapsing immediately due to a slight delay in payment. Question 14. In insurance, a peril is defined as A. The cause of a loss. B. A condition that increases the chance of loss. C. The item or property being insured. D. The financial consequence of a loss. Answer: A. The cause of a loss. A peril is the direct cause of a loss, such as fire, wind, hail, or theft. For instance, in a house fire, fire is the peril that caused the damage. Understanding perils is fundamental because insurance policies specifically list the perils they cover, named perils, or those they exclude, open perils. Think of perils as the events that trigger the need for insurance protection. Question 15. A participating life insurance policy is characterized by A. The payment of dividends to the policy owner. B. A fixed premium that can never change. C. A death benefit that adjusts annually based on inflation. D. A cash value that fluctuates with the stock market. Answer: A. The payment of dividends to the policy owner. A participating life insurance policy, usually issued by a mutual insurance company, allows the policy owner to participate in the company's divisible surplus through the payment of dividends. These dividends are essentially a return of a portion of the premium if the company performs better than expected. Dividends are not guaranteed, but when paid, they can be used to reduce premiums, purchase additional coverage, or be taken as cash. Question 16. What is the primary purpose of a deductible in an insurance policy? A. To increase the amount the insurer pays on a claim. B. To reduce the policy premium and eliminate small claims. C. To provide additional coverage for specific perils. D. To allow the insured to choose their preferred repair shop. Answer: B. To reduce the policy premium and eliminate small claims. A deductible is the amount of money the insured must pay out of pocket before the insurance company begins to pay for a covered loss. For example, if you have a $1,000 deductible and a $5,000 covered loss, you pay the first $1,000 and the insurer pays $4,000. Deductibles help lower premiums because they reduce the insurer's payout on smaller claims and encourage insureds to be more careful. Question 17. The reinstatement provision in a life insurance policy allows the policy owner to A. Change the beneficiary designation without the insurer's consent. B. Renew a term policy without proving insurability. C. Restore a lapsed policy to its original status, usually within a specified time frame, by paying back premiums and proving insurability. D. Convert a whole life policy into a term policy. Answer: C. Restore a lapsed policy to its original status, usually within a specified time frame, by paying back premiums and proving insurability. The reinstatement provision offers a valuable opportunity for policy owners who have allowed their life insurance policy to lapse due to non-payment of premiums. Within a certain period, example 3 or 5 years, they can typically reinstate the policy by paying all back premiums, any outstanding loans with interest, and providing proof of insurability, example passing a medical exam. This allows the policy to continue with its original issue age and terms, rather than requiring a new, potentially more expensive, policy. Question 18. What is the Texas Fair Plan Association's main purpose? A. To provide flood insurance to all Texans. B. To offer homeowners and renters insurance to individuals who cannot obtain it in the standard market. C. To regulate the rates of insurance companies in Texas. D. To manage the state's workers' compensation system. Answer: B. To offer homeowners and renters insurance to individuals who cannot obtain it in the standard market. The Texas Fair Plan Association, Fair Access to Insurance Requirements, is a program designed to make basic property insurance available to Texans who are unable to obtain coverage from the voluntary insurance market. It acts as an insurer of last resort, primarily providing dwelling, homeowners, and renters insurance to properties that might be deemed high risk by standard insurers due to their age, condition, or location. Question 19. Which type of term life insurance has a death benefit that decreases over the policy period? A. level term. B, increasing term. C, decreasing term. D, annually renewable term. Answer, C, decreasing term. Decreasing term life insurance is characterized by a death benefit that gradually decreases over the life of the policy, while the premium typically remains level. This type of policy is often used to cover a decreasing debt, such as a mortgage, where the need for coverage diminishes as the debt is paid down. The death benefit matches the decreasing obligation, providing appropriate coverage without overinsuring. Question 20. Under a standard homeowners policy, HO-3, which coverage form typically provides open perils, coverage for the dwelling, and named perils, coverage for personal property? A, coverage A and coverage B. B, coverage A and coverage C. C, coverage B and coverage D. D, coverage C and coverage D. Answer, B, coverage A and coverage C. A standard homeowners policy, HO-3, is a commonly used form that provides excellent coverage. Coverage A, dwelling, and coverage B, other structures, are typically written on an open perils basis, meaning they cover all risks of direct physical loss unless specifically excluded. Conversely, coverage C, personal property, is generally provided on a named perils basis, meaning it only covers losses caused by the perils specifically listed in the policy. Question 21. A policy owner takes a loan from the cash value of their whole life insurance policy. If the policy owner dies before repaying the loan, what happens to the death benefit? A, the death benefit is increased by the loan amount. B, the death benefit is reduced by the outstanding loan amount. C, the death benefit is paid in full, and the beneficiary becomes responsible for the loan. D, the policy immediately lapses due to the outstanding loan. Answer, B, the death benefit is reduced by the outstanding loan amount. When a policy owner takes a loan from the cash value of their life insurance policy, the loan is secured by the policy itself. If the policy owner dies before repaying the loan, the outstanding loan amount, plus any accrued interest, is typically subtracted from the death benefit paid to the beneficiary. This ensures the insurer is repaid for the loan without directly pursuing the policy owner's estate or the beneficiary. Question 22. Which of the following is an example of an indirect loss in property insurance? A, damage to a building's roof from a hailstorm. B, loss of business income due to a fire closing the business. C, theft of personal belongings from a home. D, water damage from a burst pipe within a dwelling. Answer, B, loss of business income due to a fire closing the business. An indirect loss, also known as a consequential loss, is a loss that occurs as a result of a direct physical loss, but is not the direct physical damage itself. For example, if a fire, direct loss, forces a business to close, the loss of business income during the closure is an indirect loss. Property policies often require specific endorsements or separate coverage, like business income insurance, to cover indirect losses. Question 23. What is the effect of the misstatement of age or sex provision in a life insurance policy? A, the policy becomes void if the age or sex was misstated. B, the death benefit or premium is adjusted to what it would have been at the correct age or sex. C, the insurer will refund all premiums paid. D, the policy term is automatically extended. Answer, B, the death benefit or premium is adjusted to what it would have been at the correct age or sex. The misstatement of age or sex provision is a standard clause in life insurance policies. It states that if the insured's age or sex was misstated on the application, the insurer will not void the policy but will instead adjust the death benefit, or the premium, if premiums are still being paid, to what the premium paid would have purchased at the correct age or sex. This ensures fairness and prevents a person from receiving coverage at a lower cost than they were entitled to. Question 24. A standard homeowners policy, HO-3, typically excludes coverage for loss caused by vandalism and malicious mischief if the dwelling has been vacant for more than a specified number of days, usually A. 15 days. B. 30 days. C. 60 days. D. 90 days. Answer: C. 60 days. Most standard homeowners policies include an exclusion for losses caused by perils like vandalism and malicious mischief, breakage of glass, or theft if the dwelling has been vacant for a specified period, typically 60 consecutive days immediately before the loss. Vacancy implies that the property is empty of contents and occupants, which significantly increases the risk of certain perils. It's important to differentiate vacancy from unoccupancy, where contents are present but no one is living there. Question 25. Who must have an insurable interest in the insured at the time a life insurance policy is issued? A. The beneficiary. B. The insurer. C. The policy owner. D. The agent. Answer: C. The policy owner. For a life insurance policy to be valid, the policy owner, the person applying for and owning the policy, must have an insurable interest in the life of the insured at the time the policy is issued. Insurable interest means there would be a financial or emotional loss if the insured were to die, such as a spouse, parent, child, or business partner. This requirement prevents people from taking out policies on strangers and potentially profiting from their death.